What do you make of that data? I don't know if you also heard Jim Cramer's comments right before this with Becky, just about how lagging these numbers may be, and perhaps maybe CPI is even less, less strong, if you will.
Yeah, I mean, I think you're exactly right, Andrew. Like, if you look at the data is lagging. I mean, housing costs up in this report. I mean, nothing is suggesting that housing costs are up here. And that's the danger of looking at relying on lagging data to base your monetary policy on. So that's the concern here. And I think what the market is showing here, we sold off a little bit, but the market, it was right in line with expectations. And I mean, that's down 0.1%. 6 months ago, when CPI was up over 1% on a month-over-month basis, no one would have ever thought we'd be looking at a minus 0.1% CPI for the month of December. So I think that's encouraging. If you saw CPI even crashing further, that wouldn't be a positive signal. That would be a sign that the economy is doing really weak. Only 4% of CPI readings throughout history since 1950 have been less than minus 0.1. So that would be a pretty ominous signal, I think, if you did see a very weak reading there. And I think
but it sounds like you're suggesting that actually things are weaker today than these numbers are suggesting. And then the question is that good or bad news in this sort of perverse, what does the Fed do about it situation?
Right. So, I mean, I think the Fed really should start to, look at some of these indicators a little more closely. The fact is, every day that goes by, we see another indicator suggesting that the economy is weaker rather than stronger. The only thing holding things up seems to be the employment picture is holding in. We have both ISMs below 50, 25 out of 26 prior readings where that's occurred throughout going back to the late 90s have been in a recession or coming out of a recession. There's only one exception. The one difference this time around is that employment is holding up. So I think in that respect, it's something that we can, breathe a sigh of relief here for. When we looked at our going to the year ahead last week, looking at what's working in the market's favor and what's not working in the market's favor, surprisingly, we saw more things working in the market's favor than against it. So that's something that, for the market perspective, keeps us slightly positive here. And I think the message going forward to the year is what you think should happen doesn't always happen in the market. Take Europe, for example. Everyone thought this was going to be a brutal winter. We were going to be on the verge of a depression in Europe. And look at the major averages in Europe right now. They're all in bull markets. The FTSE's within 2% of an all-time high. Germany and France are within 10% of all-time highs. So that's not the picture that most people were looking at 6 months ago and anticipating 6 months ago.
Okay, we're going to have to run in literally 30 seconds. What do you do about all of this?
So I think you take an approach to the market. Like I said, there's more positives than negatives in the market's behavior right here. So I think you want to, from a longer term perspective, you want to be looking and putting money to work continuously here. And if you do get a weak day, you want to put some money to work. Overall, the market is more working for it than against it.
Fair enough. Paul, thank you.